Good morning and welcome to Charting the Markets on Friday, the 29th of September. Better than expected preliminary Japanese industrial production and also a positive close on Wall Street overnight on dovish comments by Federal Reserve members Goolsbee and Barking have led to Asian markets stabilizing this morning, and this came despite Japanese consumer morale falling to a 6-month low. So let's begin by having a look at the Nikkei 225 change, and you can see here that we have bounced off yesterday's low on this daily financial bet at 31,665 or so, and are forming this second hammer formation here, which potentially could mean that next week we could be heading back up again towards the late or the mid-September lows, and also the orange line here, the 55-day simple moving average, around 32,450 to 65. So that is a distinct possibility. And it may even mean the end of the decline we've seen over the months of September, because what we can see here is a three-legged decline, an ABC zigzag Elliott wave correction. If that is indeed the case, and if we were to remain above the August low at 31,251, it could indicate that the corrective phase we've seen basically since June of this year might have ended, and that we could head into the end of the year on a more positive note. But we'll have to really hold above this key support level here at the August low at 31,251 for this to happen. And what we also need to see from a technical perspective is a rise and daily chart close above Monday's high at 32,757. That's the last reaction high, which is to say a high on this daily candle, which is higher than the one to its left and to its right. And if we overtake that, then the bulls might be back in control for the Nikkei 225. Now, the FTSE 100 has done actually quite well over the last few days, even though it did come off as other US and European indices did as well as Asian indices. But because of the high oil price, basically helping constituents of the FTSE 100, such as companies like Shell or BP, to rise, the FTSE 100 has done extremely well. And yesterday, it actually bounced off the orange line here, the 55-day simple moving average at 7,530, and also its August to September uptrend line. And this morning, as UK GDP beat estimates on headline year-on-year and also with regards to business investment metrics, we have managed to rise above the red line here, the 200-day simple moving average at 7,650, which is a positive development because it does indicate that if we were to manage to close above the 200-day simple moving average today, which is Friday, the end of the week, we could be in for a move higher next week, which would then take us back to the highs seen back in July and also September of this year, 7,723 to 47, and above there would take us perhaps back towards the highs seen at 7,938 in April. So the FTSE actually looking quite positive so far, and it could rise further over the coming days, provided we stay above this week's low at 7,523 on a daily chart closing basis. Moving on to the US, what we've seen here is also a stabilization, which is kind of interesting because the low made this week at 4,239 was made marginally above this key long-term support area, which consists of the early to mid-May highs and also the red line here, the 200-day simple moving average between 4,214 and 4,187. And we managed to just hold above there, and we are now consolidating higher. And the reason for this is that basically US GDP came in pretty solidly at 2.1% for the second quarter. Initial claims once again fell below forecasts. And even though consumer spending was revised sharply lower, you also had, as I said, these dovish comments by US Federal Reserve members Goolsbee and Barking, which helped to push equity indices higher again on basically short covering as well, because don't forget, over the last few days, you can see here, we've had 9 consecutive daily lower closes on the S&P 500 take us down to this 4,239 low we saw on the daily financial bed, to levels last traded basically in at the beginning of June of this year. So what we need to do now for the bulls to be back in control is basically overcome this key resistance area between the late June and also the August lows between 4,328 and 37, and probably even take out the next higher 10th of July low at 4,378 before the upside can gain some traction. So the key level to watch out for is this week's low at 4,239, and then below there, this key support area between 4,214 to 4,187. Now, I personally believe that we are quite likely, if we were to test that area, to hold, and maybe we could see a lower low and then a reversal to the upside, ending this large ABC, potentially Elliott wave corrective move in this overall still uptrend. And that could mean that the autumn correction has actually ended with regards to equity markets. But we aren't there yet. We need to see what's going to happen over the next few weeks. The US dollar, despite coming off of the last couple of days on dovish comments by Fed members Goolsbee and Barking, basically is still on track for its 10th or 11th, I believe, even weekly straight close higher. And this is quite extraordinary. We haven't seen this in a very, very long time. I think we had 9 consecutive closes back in 2014, but I don't even know how far we need to go back to see 10 or 11 consecutive weekly closes here. You can see on the daily chart, we've risen all the way from 99.13 on the US dollar basket back in mid-July of this year to 106.49. And that was a level which we traded last at back in November of 2022. Now, short term, we're coming off, probably on profit taking at the end of the month, at the end of the quarter as well. And you can see here that profit taking the US dollar basket back down again towards the lower uptrend channel support line here around the 105 mark, 105 mark, I should say. Now, if you translate this to euro dollar, for example, because the euro makes up 57.6% of the US dollar basket, this is the inverse of that chart. You can see we have declined from the 112.75 higher made in mid-July to this week's low at 104.88 before reversing our trend and bouncing off these lows. And we can see here that we actually managed to hold marginally above this key support zone made up of the mid-December and January lows between 104.84 and 44. So that really is key support with this week's low. And basically, we can bounce off this support area and head higher again, hopefully over the coming days and weeks. But for the bulls to be back in control, we really need to take out the last reaction high, and that is a long, long way away at 107.36, last Wednesday's high. So that would need to be taken out for us to revert to the upside. But until we do, we still have a series of lower lows and lower highs, which is the definition of a downtrend. And short term, we are heading today to the May low at 106.36, which may actually act as resistance over not just today, but also the coming days. Now, if you move on to the British pound, you can see the same happening here. We dipped down to a low this week to 121.11, which was last traded in March of this year, and are now bouncing off very rapidly, having seen 6 consecutive days of lower closes for cable. And now we are basically heading towards the upper trend line, downtrend line, resistance line here at 122.80, and also the May low at 123.09. But that, together with the low at 123.45, the 10th of April low, could act as pretty good resistance going forward. And here the last reaction low is actually the Tuesday of last week, so the 19th of September at 124.24, and together with the red line here, the 200-day simple moving average at 124.37, would need to be overcome for us to say with more confidence that we've ended this downward rut in cable in the US dollar. And if you look at Japan, here we can see that the US dollar versus the Japanese yen rallied all the way to 149.70, very close to the psychological 150 yen area where the Bank of Japan might actually intervene to stabilize its currency pair, as it did back in October of last year. As you can see here, we rallied back then to 150.194, but then had intervention take us all the way back down again. And after that, the currency pair slid quite significantly. But you can see here that we've had a very nice up move in the US dollar versus the Japanese yen. And right now, we're just consolidating short term. We retested our July to September uptrend line earlier this morning, slightly slipped below it, but now are already bouncing back as the US Senate passed a bill yesterday evening to avert a government shutdown. But time is really still running out to resolve the issue before funding runs out on Sunday in the US. So maybe that could lead to further downside being seen next week with regards to the US dollar. Now, with regards to the US dollar, what we've seen is a very sharp rise in the American currency pair against all kinds of currencies over the globe. And the impact of that rising dollar on commodities has been quite negative, as we can see here on the on the gold price. We can see here that we've fallen for 4 consecutive days this week to $1,858 per troy ounce, and that is a level that we traded it at last in March of this year. And now that the US dollar is starting to come off slightly, we can see the gold price bouncing back ever so slightly, but it is encountering some pretty important resistance between the late June and August lows, between $1,885 and $1,893 per troy ounce. So that is really, really good resistance going forward. I wouldn't be surprised if that were to cap the upside in the short term. If it doesn't, we also have resistance at the mid-September low at $1,901 per troy ounce. So we'll have to really see what the data is out of the US later on today, because at 1:30 p.m. we've got the Fed's preferred measure for inflation, which is the PCE price index, and that is expected to rise to 3.5% year on year and 0.4% month on month, compared to a previous rise of 3.3% and 0.2% in July. So a slight rise expected to happen there because of the rising oil price we'll look at in a minute, and the impact that has on inflation. Now, with regards to core PCE, that is expected to come in at 0.2% month on month, in line with July's number. At 2:45 p.m., we have US Chicago PMI data out for September as well, and that we expect to rise to 49. So perhaps these data points could have some influence on the gold price going forward. Now, talking of crude oil, what we can see here is the Brent crude oil chart, and yesterday we rallied to $95.33 per barrel, and that was a level we last traded at in mid-November of last year. But what is interesting from a technical perspective here is that the high we made this week is higher than the high we made last week, and this has not been confirmed by the relative strength index here at the bottom of this chart. So you can see here the RSI, which is this oscillator, is making a lower high this week compared to last week's high. And when that happens, when the price makes a new high, yet the oscillator makes a lower high, it doesn't confirm the upward move and the momentum to the upside, and often points in around 70% of cases or so to at least a short-term correction in the opposite direction of the trend being seen. So basically, this negative divergence we're seeing at the moment is a warning sign that perhaps over the next few days and perhaps even weeks, we could see some consolidation happen in the oil price. Now, for a top to be formed from a technical perspective, though, what we would also need to see is a fall through this week's low at $90.49 on a daily chart closing basis. And ideally, we would also have to fall through the July, or actually June to September uptrend line, which today comes in around $87.84. So that is quite a long way away. But only if we were to fall through these levels would we form a kind of top formation. Otherwise, we probably will see some sideways consolidation for a few days, like we saw last week, for example, before we continued to the upside. Now, last but not least, I'd like to very quickly mention natural gas prices, because these look quite interesting from a technical perspective. And here what we are seeing is that the price of natural gas in the US over the last 3 days has risen quite significantly and is in the process of retesting its current September high at $3.02. And if that were to be exceeded, we also have pretty good resistance at the August high at $3.05. Now, that represents pretty important resistance, and in the past we always failed around the $3 mark and came back down again. But as you can see here, since April of this year, we do actually have a rather jagged, I have to say, but still upward trend. We have higher highs and higher lows, and then since August of this year, short term, we also have higher highs and higher lows, taking us back towards these highs. So it is quite possible that this time around we might actually break through the $3.02 to $3.05 mark, and also the March high at $3.05.6. So that is a possibility, and if that were to happen, I wouldn't be surprised if the price of natural gas were to rally pretty rapidly towards the $3.50 mark. But this is a big if. But all I'm saying is that upside momentum is currently pushing against major resistance. And provided we stay above this week's low at $2.79, further upside looks to be more likely than any reversal to the downside. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter. My handle is @AxelR_IG. Have a lovely weekend. Goodbye.